Hey guys, John Paulamy here, Actionable Intelligence. Today's Saturday, September 14th, 2019, weekly market update. So in this week's rant, just wanted to talk a little bit about the news this week that the ECB cut rates from negative 0.4 to negative 0.5. The central bank, the European Central Bank, also will restart bond purchases in November at a rate of 20 billion euros per month. So here we are again. We have economic growth faltering in Europe, especially in Germany. And so what the ECB has done is go back to the well that is dry of cutting rates and buying more bonds of their bankrupt countries that are in the European Union. Now, this did nothing, in my view, to stimulate growth in Europe during prior attempts at this same policy. So we're going to go back and do it again, because this is what central banks do. They don't have, they have this big hammer. I've talked about this before. They have this really big hammer. It's called being able to raise or lower interest rates. That's all they can do. And so every problem, they just beat on it with this hammer. The problem in Europe and in the West, well, not the only problem, but some of the main problems for the economics of the countries are that they're in demographic decline, that they have entirely too much regulation, the taxes are too high, and the economies are not competitive. Now, people don't want to accept that. People want something for nothing, but then, then that comes with a trade-off. You're not going to have a dynamic economy when the government's, 40 or 50% of the economy. And if you think you have everything for free, well, then you're going to have to suffer with lower economic growth. What Europe needs, what the West needs, is less regulation, lower taxes, less government intervention in the economy. But we're going exactly in the opposite direction. And that's what this whole thing is about, the politics that are going on. That's what Brexit is about. That's what Trump is about. It's not orange man bad and white racist. It's, the middle classes and the working classes have not advanced in 20 or 30 years in this country or in Western Europe. That's why you're seeing, all the political machinations that you're seeing. That's why you're seeing the rise of populism. The bureaucrats that, control things in Europe, in the European Union, they don't want to give up their power, their wealth, and their prestige to a bunch of, to democracy. I mean, Nigel Farage has talked about this. You can watch his speeches in the European Parliament. This is exactly what he talks about. He tells it to their face. They don't care about democracy. Expect more populism in coming elections. I was listening to a podcast this week that Dan Ferris from Stansberry Research, and he interviewed a guy named Kevin Muir, who's a Canadian guy, and they were talking about what is the biggest bubble out there, which is sovereign debt, in my view, and in Kevin Muir's view. But one of the things he was saying is that, everybody's counting on deflation. We're going to have this big deflation. We're going to have inflation's dead. You can see it. The economies are, contracting, blah, blah, blah. But what about if the contrary to that is what's going to happen? What if, we're going to see, even the Germans are talking about now doing some fiscal spending. And what I think is going to happen is, as we go through these various election cycles over the upcoming years, and I agree with what was talked about on that call, and that's why I've been saying about MMT and spending money and physical spending, that's, as the older generation of these, liberal, central, neoliberal center crumbles, the post-World War II structure crumbles, these young people are coming up, these millennials, they have different ideas, and they don't like not having a chance to advance and share in prosperity. So I think you are going to see fiscal spending. I think you are going to see MMT. You can't just do it with interest rate cuts. It doesn't work anymore. That model is done. There's no more juice in that lemon. So I think the old guard, you've got Christine Lagarde, running I think she's going to be the new ECB president. She's a lawyer. I mean, what does she know about anything? I mean, this is just recirculating these bureaucrats so they can keep the same power structure in place, but it's not working. And they're doing everything they can. The people that are thinking they're in control, the old elite, this whole thing's crumbling around. Look what's going on in Brexit. Look what's going on in Italy, where Salvini's party, Lega Nord, was surging in the polls, and so its partner, they broke away from Five Star, and Five Star partnered with the socialists because whatever it takes to hold the old non-working machine together, that's what they're going to do, and it's going to crumble. And so we are going to see, that's why I think inflation is going to be the thing that surprises. The cover of Business Week about a couple months ago, inflation is dead with the inflatable dinosaur laying on its side. I mean, that's the classic, bottom right there. Everybody's on the deflation side of the canoe, and I think that people are going to be surprised that inflation is going to be the thing that comes back and bites people in the butt. Now, as far as gold is concerned, I just want to show this chart. Gold has really been rallying to recent all-time highs in euros. Why? Because negative interest rates are positive for gold, and the further they go negative, gold's pulled back here recently, not only in euros but in U.S. dollars, but it's going higher. The U.S. is on a new rate cutting cycle, regardless of what Powell and the Federal Reserve says. They have to cut rates, or the dollar is going to surge against these currencies, and that's not going to be allowed to happen. You'll have emerging market debt crises. You'll have U.S. exporters screaming to the government about they're not going to be competitive anymore. I mean, it's happening all over the world, guys. So I wanted to talk about that. That's the reality check. You're going to see more and more, trying to use policies that haven't worked. Now, they'll be good for certain asset classes, stocks and gold and things like this, up to a point. But, we're kind of in never land now. The ECB is following the Bank of Japan, and the U.S. will be following the ECB and the Bank of Japan into this world of buying their own bonds. Would anybody listening to this podcast buy negative yielding bonds from the German government or from the Italian government or from the Japanese? I wouldn't. These are certificates of confiscation. So that's it for the rant. This last week, or maybe it's 2 weeks now, they had the World Nuclear Association Symposium in London. Brandon Munro sent out an email from his thoughts, Brandon Munro being the CEO of Bannerman Resources. It's one of our go-to guys that we like to listen to. Now, he sent out an email. I'm going to hit some of the highlights that were in his email that he sent out to his email list. I understand that he is the CEO of a prospective uranium producer, Bannerman Resources, so he's going to be apt to be talking his own book. I neither endorse the views, I'm just reporting. That's what I'm doing. But I think that it's, not only him saying this, but it's other folks. I listened to a podcast. Mike Alkin was at the conference with his guys, and he was on his podcast last week. I suggest you listen to it. They talked about some of the things that were being discussed there and some of the outcomes. But let's focus on, with those caveats in place, let's focus on Mr. Munro's comments. He's saying that, for the first time since 2010, the sector was broadly upbeat, and the mood was only a little short of contagious optimism. Interestingly, this year it attracted financial investors despite its technical orientation. I counted 18 registered investors and equally as many on the sidelines. And he names them in his email, which I'll put a link to in the show notes. Mike Alkin's outfit, Yellow Cake, Uranium Royalty, UPC. I mean, there's a lot of people there. This is more of a technical show, symposium, and there are quite a few investors there. And that's what you're going to need, because us retail investors aren't going to drive this thing, guys. When these charts start turning up, we're going to need the bigger, hedge funds and private equity money and family office money to come into this market once it starts moving higher and gets on trend to push this thing higher. Retail punters aren't going to be the ones that drive this thing. There was some rehashment in his comments of some of the things you already know, but I think they're worthwhile to talk about. By the end of 2020, a further 19 new reactors are scheduled to start up. He says Rosatom, which is the Russian state nuclear corporation, has now reached the holy grail of reactor sales, series construction. So he says in this email, he goes into more depth. One of the big problems with nuclear power, to the delight of many people that are against it, is that it's very expensive to build and takes a long time. One of the reasons is different competing technologies, plus the fact of the regulatory environment that is there to bog down the construction of these reactors. And what he's saying here is that the Russians now have got this thing down where they can turn these things out. I'm not going to say as quickly as track housing in a subdivision, but that's a similar thought pattern, and do it in a timely, on-budget methodology. The medium-term outlook is also strong, driven by a growing belief that the renewables bubble will deflate the next 12 to 24 months. Now, I think this is more opinion. I'm not sure that's going to be the case, especially in the U.S. I don't think it's been working. You can look at what's happened in Germany. I do think that the zeitgeist is slowly turning against climate change, CO2, and then the holy grail of renewables that is being proposed by the proponents of man-made climate change as the end-all be-all solution. And I think that there's been a lot of work done, a lot of intellectual battles are happening in the Twitter sphere, in giving lectures. A lot of guys are out there fighting this battle to say, hey, look, if you believe that CO2 is what is going to cause an irreversible warming of the earth, then you have to be for nuclear power. You cannot be against it. It simply is not possible to scale renewables up to the scale that we need to in the time frame that the alarmists are putting out there. So you have to be pro-nuclear if you actually believe that man-made CO2 emissions into the atmosphere are causing a runaway climate change, or heating of the earth, if you will. Consistent with the slew, I think this is a very important quote here, consistent with the slew of good news coming out of the industry, the Nuclear Fuel Report projects, for the first time in 8 years, an increase in uranium demand in all scenarios. The reference scenario projected demand increasing at around 2% per annum, with the upper scenario at 3.5% growth. So I will put a link to this email he put out. You can read it. Like I said, he does run a uranium company, so he is going to be looking for the most positives to reinforce the view. We have to be careful of confirmation bias, but we also have to be careful not to fall into recency bias. And confirmation bias being that you look for things that validate your own thinking or biases. And recency bias being you falling into the trap that, well, because uranium's $25 a pound yesterday, it's 25 pounds today, it'll be $25 a pound tomorrow. And you can't do that. You have to be looking at the information. And the thesis is still in play. Less supply of uranium, more demand for uranium. It's just that simple. Report came out. I'm probably going to buy it. It's only 20 euros, but International Atomic Energy Agency projects up to 25% growth in nuclear power by 2030. Again, an agency that is dedicated to atomic energy, so it has to be taken with a grain of salt. However, quote from the report, the new projections to 2030 see generating capacity declining by some 8% in the low case and increasing by 25% in the high estimate. By 2050, it is seen falling by 6% in the low and rising by 80% in the high case. Now, it's probably going to fall somewhere in between. It's going to be growth, but I don't think it'll be to those high ends, but you never know. Um, with the Chinese now, I mean, I read an article. Somebody sent me a article to review. And I'm not going to try to refute every single article, but I will speak to this. It was by a guy that has the, I can't remember the name of the site now, but it was just another rehashment of all of these shibboleths and canards that we have in nuclear power, that it's declining around the world. It's not declining, okay, in the West and in the U.S., which don't matter anymore. When are people going to get it through their head? The U.S., the Western liberal democracies are in decline. The growth is in Asia, okay, where you have 2/3 of the world's population that is developing and is advancing and is urbanizing, okay, and is choking on coal particulate matter. That's where the growth in nuclear is going to be. It's not going to be in the West. It's certainly not going to be in Western Europe when it's taken over by North Africans and Sub-Saharan Africans. I don't see it. That's going to be a place of turmoil for the next several generations. It's not going to happen in the U.S. when we have one political party that has bought completely lock, stock, and barrel into the fact that the world's going to end in 12 years and that we have to put up as many windmills and solar panels as we can. The growth is in emerging markets. It is growing. We have a certain amount of reactors. They're adding to them every year. That's not a decline. The only thing that derails this is if you have a major accident. And it only derails it for a few years because there is no choice unless you want to burn coal and natural gas. You have Elizabeth Warren saying she's going to ban fracking on day one of her administration via executive order. How are you going to lower CO2 emissions, Elizabeth? More windmills? What happens when the wind doesn't blow? What happens when the sun doesn't shine? Oh, we're going to have batteries, John. What batteries? The technology's not there. I'm all for interstellar star travel. I want to be one of the first ones that's on the Starship Enterprise and goes to Alpha Centauri. Eventually, I'm sure, unless man destroys himself or the Yellowstone supervolcano destroys the world, eventually I'm sure that we're going to have interstellar star travel. It's not going to be in my lifetime. There are limits to technology. Just making proclamations don't get it done. No one's building new uranium mines, not at $25 a pound. Yet you're destroying more and more inventory every day. You're burning it up in the reactors. You're not replacing it. The bottom line with uranium is it is going to be a bull market of historic proportions. If you cannot wait it out, you will not participate. It's that simple. I have no clue if it's going to be a year, 2 or 3 years. It's going to happen. We can sit here and rub our hands and do all this, mental masturbation, which goes on in the Twitter sphere and our message boards. The bottom line is more reactors are being built, more uranium. Every day we sit here, uranium pounds are being used up in reactors, and it's not being replaced. There are no new mines being built. This is a chart from a guy that's on Seeking Alpha HFI Research. I think this is pretty good. We're switching to oil now. U.S. oil production growth is slowing. I think people aren't getting this. Chart on the left, or numbers on the left, indicate barrels of growth in millions. So you have 1 million barrels, 1.5, 2 million barrels of growth. Then you have the percentage growth per year. Look what's happening. Yes, the United States is the biggest oil producer. It's exporting tons of oil, but the growth is slowing. Why? Well, there's several possibilities: over-indebtedness, inability to generate cash flow, the economics of the shale plays, the fact that the geology might not be what we think it is, the cherry picking of all the tier 1 drilling locations. What I think is going to happen is I think a lot of people aren't paying attention to this. They think that oil is kind of the same story what we have in these commodity markets. The shale phenomenon, if you will, that was precipitated by low interest rates, kind of displaced a lot of the conventional oil investment that should have happened over the last 10 years. And I think that if this story continues to play out, which I believe it will, U.S. shale is not going to go away, but I mean, we have to see going forward over the next 6 months, year, 18 months, has it plateaued? Is it going to decrease? Because declines continue in oil fields. Again, this is an extractive industry. If you're not replacing the barrels that you pump out, eventually you go out of business. If you don't invest and recycle cash flow into new resources, that becomes a problem at some point. And I think the data is starting to line up that that's exactly what's happening. And I think people are going to be shocked. I don't think the economy is going to turn down like people think. Yes, I see that the PMI in manufacturing has dipped under 50 slightly, but that's happened before. We have massive money printing going on around the world. And I think the thing that's really going to derail the economy is higher energy prices. I think it's going to be a situation where very few people see it coming. The lack of investment, the lack of understanding around depletion, and the lack of accurately thinking about demand growth, that regardless, unless you have some type of great financial crisis like in 2008, you can bank on 1 million to 1.5 million barrels a day of demand growth every year. And I don't think that the Permian Basin is going, based on this, and maybe this is just a reflection of lower oil prices. Maybe if oil prices go up to $75, $80, $100 a barrel, if they were to go there, maybe this turns around again. Maybe this ramps right back up, like what happened here. I don't know. We'll have to see. Interesting, as the time of the making of this video, the Yemeni Houthi rebels in Yemen launched a drone attack against Saudi Aramco facilities in Saudi Arabia. We don't know the extent. It was on Twitter. Massive explosions at some of these large facilities in Saudi Arabia, attacked by explosive carrying drones, evidently. So we'll need to see what happens on that over the rest of the weekend and into Monday. It might not be a big deal. It could be a big deal. We don't know. But if it is, then we will see how precarious the oil markets really are. Switching to offshore, this is Valaris, the old Ensco, off their recent investor presentation on their website. I thought it was interesting. Hey guys, it's happening. It's undeniable. Amount of fixed investment decisions is increasing for major projects. You can see that was the bottom, 2016. We've been growing every year. Combined annual growth rate of offshore capital expenditures is growing every year, or projected to grow. We're seeing, if you have more project approvals, the amount of spending is going to go up. Now, I don't know if it's going to go up as quickly as people want it to, and that could be a problem for some of these operators. But the bottom line is, look back to 2014, $328 billion in offshore spending, and we're not even, we're only looking at 2023 being 2/3 of that. Now, I think that we are going to see an oil shock at some point over the next several years, and I think whole dynamic's going to change. But regardless, if it doesn't, we still need to go out and find this oil. We have found, with the amount of oil that we have used, for every 4 barrels of oil that we use, we only find 1 new barrel. At some point, that's going to be a problem, especially if oil demand continues to increase in these emerging markets like India, Bangladesh, Indonesia, China. I can go on and on and on, and they will increase as people get wealthier. We've demonstrated that via the S curve, that as people get wealthier, their spending and demand for petroleum products goes up. Wanted to talk about the Bassoe analytics. I think if you're not on there, you should be. It's free. But this is the Jackup rig market summary. Came out September 11th. Basically, Jackup utilization continues to rise as demand, particularly in the Middle East, Southeast Asia, and Mexico, consumes an increasingly large amount of rig supply, including new builds. Since our last report, 7 previously stranded new builds have secured bareboat contracts with operators. More deals similar to these are expected to be announced shortly, with many rigs going on long-term contracts. The supply of premium rigs is decreasing, and day rates will rise further. This is what we've talked about. Jackups are going to be first. Why? Because jackups rigs operate in shallow water. Shallow water means less expensive projects. The majors, oil companies are dipping their toes back into quicker payback, less risky, less deep water. And as this market recovers and as the jackup utilization rate hits 80%, you'll see day rates start increasing. And then you'll start seeing the exploration production companies move from shallow water out to deep water. That's been the history of every recovery. It's not happening as fast as people would like, but it is happening. And this is further information about that. Now we're getting kind of long here. I want to go over one other thing. This is from the Scorpio Tankers investor presentation they just came out with. This is talking about the scrubber economics for putting those SO2 scrubbers on ships. This is what I was talking about last week when I was talking about the shipping possible rally we could be looking at. And one of the things that we talked about was the IMO 2020 requirement to stop using high sulfur fuel. Now here's the price of high sulfur fuel here. Here's these are the futures curves, if you will. And you can see that currently high sulfur fuel oil bunker fuel is very cheap. It's about $200 a ton. And you can see these are the more expensive, less sulfur in them. These are the fuels that you can use, and you see there can be up to a $200 to $300 per ton differential. So if you put the scrubber on your ship, you can continue to burn the cheap fuel, and that gives you this is the annual scrubber fuel savings for Scorpio in millions of dollars per year. As the differential increases. This is dollar per day based for each ship that has a scrubber. I mean, so you can see even at $200 per day or $200 differential, you're saving almost $3,000 a day in fuel costs. So this is what we were talking about scrubbers and the IMO 2020 and the fact that we're going to have to see how this shakes out. But right now, this futures curve shows us there's going to be up to a $200 to $300 differential in high sulfur fuel oil and low sulfur fuel oil. So if you don't want to install scrubbers, you have to use this higher cost fuel and slow steam. If you put the scrubbers on, make the investment, then you can burn the cheaper fuel and have a competitive advantage. Or that's the way the thesis is right now. But I thought this was a good, I wanted to put this on here because we talked about it last week. This was a good visual for people to look at and kind of say, okay, now I understand it. If I put a scrubber on my ship, I can save fuel, I can burn the cheaper fuel and meet the regulations. And if I don't put it on, then I have to pay up for this higher fuel cost and slow steam. And long story short, it makes a more bullish case for the industry. So that's it for this week, guys. Appreciate the support. Continue to subscribe, listen, like. Really, the channel continues to grow, and I appreciate the support. And I thank you guys for taking the time out of your weekend to listen to my musings. We'll talk to you next week, guys. Thanks.